4038. That single number may decide the future of your retirement account. In more than 155 years of stock market history, it has been higher only once, in December 1999, just before the dot-com bubble collapsed. When that happened, the Nasdaq crashed nearly 78%, over $6 trillion vanished, and investors waited 7 painful years just to break even. Today, in early 2026, we are back at dangerous levels again. The number is 40.38, and everyone at the Federal Reserve understands exactly what it represents. The real question is no longer if the market will correct, but when and how severe it will be. This figure is called the Shiller Price-to-Earnings Ratio, also known as CAPE. Created by Nobel Prize-winning economist Robert Shiller, it compares today's S&P 500 prices to the average inflation-adjusted earnings of the past 10 years. By smoothing short-term noise, it shows what stocks are truly worth over time. Historically, the average CAPE since 1871 is about 17.3. Today it sits at 40.38, more than 135% above normal. In simple terms, investors are paying over twice what stocks have historically been worth. Think of it like buying a house. A home that usually sells for $1 million is now selling for $2.35 million. While interest rates are high and the foundation is cracking, that is today's stock market. In market history, there have been only a few periods when the Shiller PE stayed above 30 during a bull run. Every single time, a major decline followed. In 1929, CAPE crossed 32, and the market fell nearly 89%, triggering the Great Depression. In the late 1960s, valuation stayed elevated, and markets went nowhere for over a decade. In 2000, CAPE hit a record 44, and the dot-com crash erased almost half the S&P and over 78% of the Nasdaq. In 2007, high valuations preceded the financial crisis, and a 57% collapse. In 2021, CAPE rose above 38 and was followed by the 2022 downturn. Now in 2026, CAPE is again above 40, the second highest reading in 155 years. History shows that after CAPE spikes, it never bottoms at elevated levels. If today's 40.38 simply falls back towards safer territory near 27 to 30, prices must adjust downward. Even in the most conservative case, that implies a decline of around 30 to 40%. In a deeper reset, losses could reach 50% or more. If the S&P 500 is near 6,900, a 33% drop takes it near 4,600. A 40% drop brings it closer to 4,100. A true crash could cut portfolios in half. A $1 million account becomes 500,000, but valuation is not the only risk. Today's market is dangerously concentrated. Just 7 companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, control more than 1/3 of the entire S&P 500. That means index investors are no longer truly diversified. If those few stocks stumble, the whole market feels it. At the same time, 2026 is a midterm election year, which historically brings volatility. Most midterm years see large intra-year drops as uncertainty rises and investors pull back. Add to that global trade tension, tariffs, sticky inflation, and a Federal Reserve trapped between cutting rates and controlling prices. Unlike 2008, the Fed no longer has unlimited room to rescue markets. Rates are already much lower, inflation is still above target, and the balance sheet is already massive. Back then, the Fed could slash rates and print trillions. Today, every new dollar printed works less than before, while government debt and interest costs are already extreme. All of these forces are aligning at once: record valuations, heavy concentration, political uncertainty, and limited policy tools. This does not mean panic, but it does mean awareness. Because when history, math, and behavior line up together, markets eventually respond. The only uncertainty left is timing, not direction. And when the reset comes, those who ignored the warning signs will feel it the most. The political will for another massive bailout simply does not exist anymore. Americans still remember 2008. They remember banks getting rescued while homeowners lost everything. That anger never disappeared. Because of that, if the market breaks again, there will be no easy rescue. This time, you are largely on your own. So let's talk about what the future could actually look like. There are 3 realistic scenarios, 3 possible paths forward. Scenario 1, the soft landing. Probability 30%. In this version, the Federal Reserve manages to thread the needle. Rates get cut 2 or 3 times, about 50 to 75 basis points total. AI investment begins to show some real return. Companies post modest profit growth instead of just spending. The midterm elections cause a normal pullback of 10 to 15%, but nothing catastrophic. China stabilizes, commercial real estate problems stay contained, and banks quietly extend bad loans instead of forcing losses. The S&P 500 corrects toward 5,900 or 6,200, down about 10 to 15%, then recovers within a few months. By early 2027, the market makes new highs. Crisis avoided. This is the optimistic case, and while it is possible, it is not the most likely. Scenario 2, the hard landing. Probability 50%. This is the base case. The market drops 25 to 35%. The S&P falls from around 6,900 to somewhere between 4,500 and 5,200. It starts with earnings disappointment in the second quarter, pushing stocks down about 10%. In the third quarter, election uncertainty and recession fears add another 15%. By the fourth quarter, recession is confirmed and another 5 to 10% disappears. Volatility explodes. The VIX moves towards 60. Unemployment climbs to 6 or 7%. The Magnificent Seven fall hard. Nvidia down 50%. Tesla down 60. The Fed cuts rates, but inflation limits how far they can go. They restart quantitative easing, but it barely works. Government stimulus is small and slow. The recession lasts 12 to 18 months. Markets take 2 to 3 years to recover. On a $500,000 portfolio, you lose about $150,000. If you are near retirement, plans get delayed by years. If you are younger, you recover eventually, but the pain is real. This is the most likely outcome. Scenario 3, the crash. Probability 20%. This is the nightmare. The AI bubble bursts. A major company admits the spending is not producing returns. Nvidia's earnings collapse, or the hype cycle breaks. At the same time, geopolitics explode. China and Taiwan, Russia and Ukraine, Iran and Israel. Oil spikes, credit freezes, and a regional bank fails under commercial real estate exposure. Companies cannot borrow. High-yield bonds crash. The Fed cuts rates to 0 and launches unlimited QE, but confidence is gone. The S&P 500 falls 40 to 50% from 6,900 to near 3,500 or 4,000. The Nasdaq drops 60 to 70%. The Magnificent Seven lose 60 to 80%. A $500,000 account becomes $250,000. Unemployment hits 10%. Foreclosures rise. Recovery takes 5 to 7 years. This is the 2008 scenario or worse. No matter which scenario happens, all of them involve pain. Even the best case is a 15% drop. The base case is 30%. The worst case is 50%. There is no path where everything simply keeps going up forever. So how do you prepare? You watch for warning signs. Warning sign 1, the VIX. Below 20 is calm. Above 25 is caution. Above 35 is fear. Above 50 is crisis. Above 70 is full meltdown. Warning sign 2, the Magnificent Seven. If one drops 20%, it's an alert. If 3 drop 20%, a correction is starting. If all 7 drop, a crash is coming. Warning sign 3, credit spreads. If junk bond spreads hit 4%, worry. At 6%, fear. At 8%, the credit market is freezing. Warning sign 4, unemployment. 5% signals weakness. 6% means recession. 7% means deep trouble. Warning sign 5, emergency Fed meetings. If the Fed meets outside its schedule, something broke. History shows these happen before major sell-offs, not after. If 3 of these flash red, reduce exposure. If all 5 flash, go defensive. Because this is not abstract. This is your life, your 401k, your house, your job. A 30% drop on $500,000 wipes out $150,000. If you are 65, retirement gets delayed. If you are 40, recovery comes. But watching your savings vanish is still brutal. In recessions, real estate falls, businesses struggle, and layoffs spread. In 2008, nearly half of small businesses failed. A repeat would be devastating. Right now, warning signs are everywhere. The Shiller PE ratio is near 40, the second highest in 155 years. 7 companies control over a third of the market. Hundreds of billions are being spent on AI with unclear returns. It is a midterm election year. Inflation is sticky. The Fed is trapped. Commercial real estate is cracking. Geopolitical risk is rising. This is not one problem. It is many problems converging at the same time. History is clear. When valuation, concentration, politics, and credit stress line up, markets reset. The question is not if, it is when and how deep. The real question is simple. Will you be prepared, or will you assume it is different this time? Because history says it never is.